Today, we are going to look at a whole life insurance policy in action. What we're going to look at is an actual policy that is about 8 years old. This individual started when I was about 26 years old. I may have met him when I was 25. And then as we did planning, we actually set up the policy, or he started it when I was 26. But over the years, he's done a great job in building up the cash value. But now he's at a stage in his life where he wants to access the cash value. So what we'll look at in today's video is his policy in action. We're going to look at adjusting the funding, the amount he's paying into the policy via premium and PUA payments, but then also taking a loan, looking at repaying that loan, and then what's the impact on his policy values. So what we'll begin with is just a quick overview here. We've got a policy that's about 8 years old, and he's done a fantastic job in funding it over the years, where he's been paying about $4,000 per month, so approximately $48,000 per year. He's been paying it monthly, so the exact dollar amount does not come out to $48K per year. You'll see the exact amounts when we pull up the illustrations, but approximately $4,000 per month. It is just about 8 years old. He's going to enter policy year 8 this February of 2023. We're shooting this video in December of 2022. So we've got 2 more months until he is complete with policy year 7. I don't know where the time goes. So he's built up a nice amount in savings. His net cash value is about $315,000. He has a loan outstanding as well for about $25,000. So I mentioned the word here, net cash value of $315,000. The reason why I added that net cash value is because if he were to pay this loan off today, he would see his cash value balance, the amount he would have access to, increase by about $25,000. So then he would have access to about $340,000, and that's what he's actually earning dividends and interest on. So a nice feature about a whole life insurance policy is regardless if I have my entire balance in cash value or if I have a loan outstanding, I continue to receive dividends and interest on any money still in cash value and what's outstanding in loans. So I receive that constant compounding, which he has experienced over the years. But presently, he's got a $25,000 loan outstanding and net cash value after accounting for the loan of $315,000, or I should say that will be his value as of February 2023. His value as of today, or before taking the loan, was almost a clean $300,000. So during our discussion a couple weeks back, he stated that he needs a policy loan for about $200,000. The specific reason why is he's going to add an addition to his home as his in-laws are moving in, and he and his wife will be taking care of them, so they want to build out some more space. So this $200,000 will give him the ability to do that. Now, as we look at the policy, he's got a present loan balance of $25,000. So how policy loans work, it's like a line of credit. If you take additional loans, it is just added to the balance. So his new loan balance will be approximately $225,000. Now, what he wants to do here is set up auto payments, just automatic drafts, to pay down that loan. He would like to pay it down in 10 years or less. So at $2,500 per month, which comes out to $30K per year, that will pay it down in less than 10 years. It'll pay it off much quicker than 10 years. What I did here was build in a little bit of extra space, meaning we went with a $2,500 per month payment instead of a $2,000 or $2,200 per month payment, mainly because right now the loan interest rate is at 5%. However, due to the rising interest rate environment, if interest rates continue to increase, more of that payment will go toward loan interest. So we built in a little bit of extra money going toward the loan to make sure that the loan is paid off altogether in 10 years. Now, quick side note on his policy loan rate. So his current rate is 5%. He's got an older Mass Mutual policy. And what that means is that one, his loan rate can only adjust 1 time per year on his anniversary date, which is February of each year. And there is a cap as to how much his loan interest rate can increase per year, which is 0.5% per year. So when we look at interest rates right now, it's higher than 5.5%, but when February hits, if the interest rate environment has prime at 7%, he'd be at 5.5% because his current rate is 5 plus the increase of 0.5% comes out to that 5.5%. So it can increase by 0.5% per year. So he's got some protection there as far as how quickly that variable rate can go up, which is nice. Let's progress on here. So he needs the loan to build an addition on his home because now him and his wife are taking care of her parents. In addition to that, he's paying for his kids' college, and it is not cheap. In addition to that, he plans on repaying the policy loan at $2,500 per month, which is 30 grand per year. So my question to him while we were on the call was this: do you still want to fund the policy at $4,000 per month? Specifically, the annual funding, so money you are paying toward premium and PUA payments, do we still want that to be $48,000 per year plus the loan repayments of another $30,000 per year, because that comes out to 78 grand a year? And his response was, that's a bit heavy right now based on everything I have going on. If I can reduce it a bit, I would prefer to do that. So we're going to look at options that show him exactly how much he can reduce it by. And we've got options A, B, and C. Option A will display no reductions. We'll look at his current path. If he said, okay, let's just keep the funding at 4 grand per month, I'll repay the loan at $2,500 per month, which will come out to $6,500 per month, a total of 78 grand per year. Option B, I pay $2,000 per month toward the premium and PUA payments, so specifically on the annual funding, money going toward the policy that builds my cash value. Then in addition to that, $2,500 a month toward the loan repayment, which gives me a total of $4,500 per month. By the way, blue represents premium and PUA payments. Purple represents loan payments in this example. And then red, when we look at red on the actual spreadsheet, that'll represent money coming out, annual loans. Then C, what does it look like if I reduce my funding to 0 and just apply $2,500 per month toward the loan payment, which would be a total of $2,500 per month. So we're going to look at these options. Then we'll wrap everything up by looking at the policy growth, and we are going to look at net numbers. Specifically, what people often like to see here is what's the total dollar amount I'm paying into the product or to the insurance company. Let's include my premium and PUA payments and also loan payments. And then what's the total growth? Meaning after I give the insurance company everything, money in, then also we can include money out, loans I receive, like what's the net dollar amount, dividends and interest that you are receiving from the insurance company. We'll look at that. And last side note is the monthly amounts we have going toward the premium and PUA payments are approximates here on the board. We have the exacts on the illustration. So what we've got is option A. And quick side note, all of the illustrations, A, B, and C we're about to look at, are all based on the detailed illustrations, which we have a lot of information here, which we're not going to go through in this video. But when we do prepare these illustrations, we do it all through the illustration software with the company that an individual has selected. And then for the sake of making things more transparent, what I like to do is export everything to Excel. However, if you are considering policy loans or just reviewing your policy, you should always receive an in-force illustration as well, as this does provide the full compliant data, all of the important information we need. Let's go back to the Excel workbook here. So we've got option A, which was approximate payments of $4,000 per month toward the policy, and then $2,500 per month toward loan payments. So when we look at the premium and PUA payments, what do we see here? Year 7, he's got a little over $8,000 going into the policy via premium and PUA payments. Why we see that dollar figure is because today we are in December. He's got 2 months of payments left, December and January, and then February is his policy anniversary date, which starts the next policy year being year 8. So that's why we see a small amount in the annual outlay column in year 7. But what we've got here Let's do this. Premium and PUA payments, then loan repayments in purple, total annual out-of-pocket. This will tally up the premium and PUA column. So this is the heavy fund example of about $78,000 per year, which he did mention is a bit heavy for him. Then we've got the annual loan coming out, $200,000. Remember, he has a loan balance outstanding already of $25,000 and change. We've got the loan interest here. Side note here, whatever the loan interest dollar figure is, it's pulling it from the year's prior loan balance. So $1,300 is way too low when calculating 5% of $226,000. It's based off the $25,000 and change above. Then we've got the cash value and death benefit columns, which represent your net cash value, and then the net death benefit, the amount that is paid out to your beneficiaries if you were to die. So when I say net cash value, the amount you have access to, so look at year 8, when we illustrate the policy loan of $200,000, once that $200,000 loan is taken, this represents the fact that we can access another $165,000. The death benefit, if we die with that $200,000 loan outstanding, or I should clarify, a total loan of $226,000 outstanding, here's the net death benefit that would be paid out to your beneficiaries. So when we look at the cash value and death benefit columns on these illustrations, these represent the net values accounting for the loan. So what we're doing here, if we look at the guy on the left, we're funding the policy through the age of 68, and we're also paying the loan down at $30,000 per year, or $2,500 per month, and at the age of 68, that loan is paid off altogether. Now I want to add something here about the $30,000 payment. If you have a loan outstanding on your life insurance policy, each year on the policy anniversary date, which is when the premium is due and when you receive your annual statement, if you have a loan outstanding, that anniversary date is when the insurance company will send you a bill for the loan interest. In his particular case, he's not paying the loan interest on his anniversary date. He does not want to do that. What he's doing is just paying $2,500 per month toward the loan and chipping away at the balance. So specifically, what happens here from a transactional standpoint is each year the loan interest comes due, it's added to the balance, but that is offset by the fact that he is applying funds toward the loan. So what happens here is each year he makes this $30,000 payment. What happens is first, it's applied toward whatever the loan interest is, and then the rest goes toward the balance. And we see as that loan interest becomes less and less due to the principal being paid down, you see more and more of that $30,000 applied toward the actual principal balance and paid off altogether at the age of 68 in this particular case. And here's his cash value at almost $1.2 million when he's 68 years old. So this is great. However, he did express that this might be a bit heavy. So let's look at option B, which is what he's interested in right now, which involves reducing the funding. So we see the annual amount is actually $23,000 per year. We had $2,000 per month. The loan repayment is not adjusted at all, $30,000. Here's the total annual out-of-pocket, adding the premium and PUA payments plus the loan payment. We've got $53,000 per year, and there's his out-of-pocket through the age of 68. There's the loan, $200,000. Loan balance, $226,000, almost $227,000 in year 8. And there's your cash value, $141,000. Do you remember what it was in option A? It wasn't $141,000, it was $165,000. You know why? Because of the funding. We've reduced the funding here to $23,000 instead of about $48,000. So that's where we see a difference there. Less money is going in, therefore, naturally, we will have less in cash value. However, what he is doing here is paying his loan down at the same pace, and there's my cash value at about $840,000. Now, one of the things he asked was this: if I'm going to reduce my funding now, can I increase it in the future? So we can look at the model with the $23K per year going toward the policy, but let's say at the age of 62, I'm cash flowing, my kids are out of college, I'm able to pay the $30K per year, but I can increase my funding back to $48K. Or I can pay $100K per year and for a couple of years. Can I do that? The answer is yes. So we can scale the payments back up. The initial design of the policy is very important in a case like that when we want to increase payments without underwriting or having to have several inconveniences. However, in his case, he can do that. So we've got the ability to scale payments back up in the future. But here's what it looks like if he just funds the $23K per year. So this cash flow is something he's comfortable with right now. The $53K total per year, which he's been paying about $48,000 per year, very close to what he's been doing. He looked at it and says, that I'm okay with right now. Let's proceed. And as a quick side note, we've got the policy loan coming out in year 8, which is the earliest we can illustrate it. He's already taken the policy loan. So we can only illustrate policy loans, in this case with MassMutual, the following year. However, he's already taken that loan out, which has increased his loan balance already to $225. And then from a strategic planning standpoint, he wants to make the actual funding adjustments on his policy anniversary date in February to match what we have up on the board, option B. Let's look at option C, because this is always a nice option to see, which displays stopping the payments altogether, premium and PUA payments. We've got one more monthly payment and then stopping, and then just allocating funds toward the loan principal. So the out-of-pocket here is $30K per year, beginning year 9. Because when we modeled the $200,000 loan, we assumed no loan payments in this year. And of course, he is paying the loan beginning year 9, so he's going to pay it down faster. But here, from a transactional standpoint, money coming out, and then the next year, money going back into the insurance company. $30K per year. Loan is paid off at the same pace in each of the examples. And there's your cash value. Over $500,000. He's already done a good job with aggressively funding the policy for the first 7 years. That's why he's in a position where he can easily stop the funding now, because he's still receiving compounding on everything, whatever's still in cash value, and the outstanding loan balance. So this is why when it's repaid, he sees the cash value fully restored. What we also did here, if you're in the business, you know what this is. In year 8, we removed the term rider. And we would do this if after having a discussion, he said, I never want to pay another penny into this. I want to repay the loan, but I do not want to add any more money into premium and PUA payments. What we would look at as an option is exactly this, which reduces the term rider. It cuts the term rider, reduces the death benefit, but by cutting the term rider, we're removing some of the drag, which if we don't plan on adding more money, we might not need it in order to prevent a MEC. So by cutting it, we can allow our cash value to grow at a faster pace. Just a little item to be aware of there that's beneficial to be aware of. So let's wrap this up by looking at some of the net growth figures, which is a lot of fun. So here, we've got option A, and you know what? Let's just look at option B, because that's the one he's interested in, which is reducing the funding to this amount, $23K per year, and repaying the loan. So to the right, we see what? Gross CV. CV stands for cash value. See gross CV, and then net CV growth. So the gross cash value growth, what do we see? I started the year after the loan is taken, just much easier to account for. We see $58,000, and then in the net cash value growth, we see $5,200. Which one do you like more? $58,000, obviously. However, to be fair to yourself, this is the one we want to look at. here's what's going on. So in the gross cash value growth, when we look at this, this is in year 9 in this particular example. The cash value was 141, and the next year it's 199, just about 200K. So if we look at the difference between years 9 and 10, it's this, $58,000 and change. And some individuals look at a policy, or they are told, well, this is what your cash value grew by from year to year. You were at 141 and change, now you're at 199 and change. So the total increase is $58,000. Wow. Not so wow. What we have to account for is the fact that we paid in $53,000. I applied money out of my pocket, sent it to the insurance company of $23,000 in premium and POA payments, and then $30,000 in loan payments. So once I back that $53,000 out, there's the net growth. And this is with a loan outstanding. I'm not paying the loan interest. My point to mentioning that is the loan interest will drag on the cash value growth a little bit, but I want to make sure I disclose that. That's very important to do. So this is not including the payments I'm making, which is my money going into the product. So it's important to do that. Here's what we want to look at, the net dollar amount. And here's what you can see down here. And you'll see it when it's highlighted in gray. What happens? Those two columns become the same. 37,105, 38,528. And the reason why is because you're not paying anything into the policy anymore. So what the net cash value growth really displays is what our cash value is growing by, or what we are receiving from the insurance company in both guaranteed interest and dividends. And that's the column that I'm most interested in when I'm trying to figure out, like, what was the actual growth, which again, this is not optimized because of the manner we are paying the loan interest, but that's okay, as long as we have awareness up front. So I hope you enjoyed this video. If you did, please hit the like button, subscribe for more. If you have any questions, please leave them in the comments below. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.